April jobs report comes in and it is bullish. So first, a couple of key highlights before we dive into the macro variables and what that means for the stock market. Unemployment ticked up slightly from 3.8 up to 3.9%, and jobs were added at a slower pace than expected on the street at around 150,000. That's my guess after corrections come in. So let's dive right in and talk about those macroeconomic factors and what this means for not only the stock market, but the short-term and long-term investment landscape as well. Now let's break down the key macro variables. Money supply growth, which leads to inflation, is down by 0.29% on a year-over-year basis. This is good news for keeping inflation down because that means that inflationary pressure isn't building, at least in the short term, in the system. Next, inflation is up 3.8% on a year-over-year core basis. This number is higher than desired, but when you pair that with April's job report, it paints a pretty good story about Fed rates not increasing in the near future because the economy is in a weakened position. Moving ahead to continued unemployment claims, this metric measures rising unemployment and is up 32% from the economic cycle low that occurred in June 2022, so almost 2 years ago. This number is very high and means that a recession is likely to occur within the next year historically because the economy is in a weakened position and prone to any kind of shocks. Moving ahead to the market discount cycle. Basically, every 3 to 4 years, the market performs poorly due to an alignment of fiscal and monetary policy with the political cycle to either address rising inflationary pressure that is occurring or allowing for rising unemployment rates without adding to debt. Right now, we are at year 2 in the market discount cycle, and that's important to note because even though a recession is possible within the next year, the discount cycle dictates that it's not likely that coordinated actions will be taken that impact the stock market. So that's important to note there that we are in year 2. And if you think about this being a year where November is coming up, then we really don't think that there'll be aggressive tightening policies going down the pipeline. Next, the major cycle. So this is when major world-changing domestic and international conflicts follow a cycle that begins every 84 and 248 years approximately. So right now in that cycle, we are at year 83 and 248, which means we're about to enter into that major conflict period. Now, this is very important to understand because major cycles mean that wildcard events could occur in the stock market when they triangulate with that market discount cycle in the near future. The S&P valuation right now is overvalued, which means that when there is some form of correction that occurs with the market discount cycle, then it will be larger than average. Right now, we're coming in at 27.8 in the aggregate for the stock market, and then the average was 21.5. When you think back to 2022, that's where similar valuations drop now. The market itself went about 20%, but some of those tech names did a lot bigger, 50, 60, 70%. So that is something important to keep an eye out, that we are not in pure bubble areas, but we are in a overvalued stock market. Monetary policy right now is favorable to the stock market, and interest rates should continue to remain about the same, if not decrease, depending on the level of shocks to the system. Right now, if my base case is that interest rates will continue to move along right up until the end of the year almost, where some rate cuts should happen. That will translate through the market channels like the 10-year note before the end of the year. So monetary policy is favorable to the stock market. Fiscal policy is also favorable because we are in market cycle year 2, and given the landscape, we're not seeing things that would take away from government spending. Now, before I give my prediction on what this means for the stock market, if you want to learn about the key cycles that drive the stock market and get stock rankings to find the very best opportunities, make sure to go ahead and click the link down below. Now, here's the deal. The macroeconomic landscape is favorable at the moment for stocks, and especially those great opportunity stocks. But at the same time, the long-term picture is not good because of A, the major cycle, B, the geopolitical risks that are happening, and C, also the confluence of the market discount cycle as well. So we'll talk more about that in other videos, but at least in the short term, the environment is favorable for stocks and those great opportunities, and that will continue to ride into the near future as well. data dependent, and I'll be covering that in lots of other videos. That's all. Make sure to subscribe to the channel so you don't miss any stock rankings or daily videos, and I'll see you guys on the next one.